Welcome to the Roundup, covering what's important to accountants and advisors across the month of March. This month, we're going to look at the exposure draft legislation on the thin capitalisation provisions, and we'll also look at why the ATO is interested in Part 4A. On that, Michael, the ATO have issued a brief update on the Part 4A panel. How does this fit in with the practical application of Part 4A?
Yeah, well, the ATO has issued this guide explaining basically who is on the Part 4A panel, the General Anti-Avoidance Rule panel, and just explaining a little bit about kind of what the purpose of that is. Now, Part 4A is pretty serious. We're moving into serious territory if we've got the ATO seeking to apply a Part 4A determination. And I guess it's helpful for taxpayers to know that when the ATO considers Part 4A, that it's not just the ATO's views that get taken into account in determining whether there ends up being a Part 4A determination. So the ATO has a pretty detailed practice statement that's been around for a while now, which is basically the instruction manual for ATO staff explaining the operation of Part 4A, running through a lot of the case law in that area, and basically giving ATO staff a bit of a roadmap for how do you go about determining whether something is actually a Part 4A problem or not, and then how do you go about raising an assessment, all those sorts of practical things. Well, one of the pieces to the Part 4A puzzle is there is this panel that's set up and it has a mixture of people on it. Only some of them are ATO representatives. So there's a handful of people who directly come from within the ATO who sit on this panel, but then there are a number of experts, tax experts, who are not from the ATO, who also make up the balance of the panel. And there are more of the non-ATO experts on this panel than there are ATO employees effectively. And basically what the idea of this is that this panel will take a look at Part 4A cases and provide their advice, their guidance, their thoughts on whether this is something that the ATO should pursue under Part 4A. Now, what the panel says is not binding. The ATO doesn't necessarily have to go along with what the panel says, but I guess it's probably to some extent a little bit comforting to know that there is an external group that are going to look at things before Part 4A is applied. Now, the ATO might completely disregard what the panel says and seek to apply Part 4A anyway, but this is how Part 4A assessments, well, part of the puzzle anyway, of how Part 4A assessments come about.
There seems to be a lot of talk around Part 4A. Where is this coming from? Is there something going on?
Yeah, that's an interesting comment. We run a help desk service. Lots of accountants are asking us lots of questions all the time. And we've definitely noticed a trend towards people considering Part 4A or thinking through a potential Part 4A exposure when they're thinking about how their clients' transactions and dealings are possibly going to be viewed by the ATO. Now, there's not a black and white answer in terms of why this sudden level of interest in Part 4A or the renewed interest in Part 4A. I suspect some of it, though, does come back to the Guardian case that we actually talked about earlier this year. Now, this was a case that we've kind of been keeping our eye on pretty closely because it is a case that primarily, anyway, dealt with Section 100A. Those trust reimbursement rules that a lot of us have been really focused on, particularly over the last 12 months or so, as the ATO has released more guidance or more up-to-date and thorough guidance in this area. Now, that was an interesting case for a few reasons. The Section 100A issue kind of didn't really go anywhere in terms of the full federal court decision. The full federal court said that Section 100A did not apply to this particular arrangement. However, the ATO was successful when it came to Part 4A. So the ATO had basically said, look, we think Section 100A applies to this arrangement, but if it doesn't, well, we think Part 4A could apply. And the full federal court effectively, at least for one particular income year, now not every part of the dispute kind of ended up a Part 4A issue, but the full federal court said that for one particular income year, the arrangement did trigger Part 4A, and it was reasonable for the ATO to issue a Part 4A determination. Now, just to recap the brief facts of that Guardian case, basically what happened was we had a number of entities, a kind of large group, had been trading. A number of the entities within the group had kind of been winding down and were in the course of being shut down and wound down. The taxpayer set up a new company on the basis that a trust within the group would be able to distribute income to that company. The company would be able to receive those funds and make investments, and that company would basically be a new investment vehicle for effectively that private group. Now, what happened though was within a relatively short period of time, the company, which had received distributions from the trust, paid franked dividends back to the trust, same trust, and the trust then distributed that franked income to a non-resident beneficiary. Franked dividends distributed to a non-resident beneficiary are not subject to Australian withholding tax, not subject to any further Australian income tax. Now, the non-resident beneficiary can't utilise the franking credits. Effectively, what it means is that the tax paid by the company on the income that came through the trust was the final Australian tax. Now, the ATO said, well, this is something that Part 4A could potentially apply to, and the ATO's alternative hypothesis, which is one of the fundamental aspects of Part 4A, basically what else could have been done by this taxpayer to end up basically with the same commercial or financial outcome? Well, the ATO said, rather than distributing income from the trust to the company, dividends back to the trust and then to the non-resident beneficiary, the trust could simply have distributed the income straight away to the non-resident beneficiary. And that would have led to a higher tax liability. Now, in the end, the full federal court said, well, it was reasonable for the ATO to apply Part 4A there. There were a series of steps in this series of transactions, this arrangement as a whole, which didn't really seem to serve any commercial purpose. They only seemed to serve a tax benefit purpose. Now, obviously, this is a very specific set of facts. This is a court that is ruling on a set of facts. It doesn't necessarily mean that the floodgates are open when it comes to Part 4A. But this does cause some concern. And I think as people have started to digest the decision in that case a little bit, they have started to feel just that little bit more worried about Part 4A than maybe what they were previously. Again, a lot of us have been so focused on specific rules such as Section 100A over the last year or so, it's very easy to lose sight that just because a specific integrity rule doesn't catch you, it doesn't mean that Part 4A couldn't come along and kind of catch you in the end anyway. This raises a whole lot of questions in terms of, well, will this influence how the ATO possibly views trust distribution arrangements in general? Does this mean that distributions from a trust to a corporate beneficiary, particularly where funds are maybe kind of lent back into the trust or allowed to remain in the trust, while we have some ATO guidance suggesting that if that's done in a certain way, the risk of Section 100A applying might be relatively low, where on earth do we stand from a Part 4A point of view? We simply don't know. The ATO doesn't discuss that in the Part 4A, in the Section 100A guidance. So I guess the important thing to remember is, just because a specific integrity rule doesn't apply, that doesn't stop Part 4A from applying. And the Guardian case is a perfect example of that. So as, for example, we look at the ATO guidance around Section 100A, as we get towards 30 June, and we're thinking about helping our clients with their trust distributions, and we're focused on that Section 100A issue, maybe we're focused on the Division 7A issue, don't forget that, again, sitting to the side of all of that is Part 4A. And that's where there's a huge question mark at the moment in terms of where is the ATO going to go following the success that they've had in the Guardian case. And there isn't an easy answer to that at the moment. And it will be up to us, I guess, as advisors to make sure that that is part of the analysis that's done. Part of the tax analysis is considering potential Part 4A risk. So I don't have an easy answer for you on that, but that case possibly explains why we're receiving a lot more questions around Part 4A and why people are just feeling a little bit uneasy about that whole area just at the moment.
And from Treasury this month, a new exposure draft with the proposed changes to thin capitalisation rules, which, as you know, deal with interest deductions for multinational groups. Matthew, where are these changes coming from?
Well, this was actually expected and it has been in the pipeline for a little bit. These proposed draft changes to the thin capitalisation rules were announced as part of Labor's last budget. Now, the thin capitalisation rules basically apply to multinational groups in order to prevent them from claiming excessive debt deductions in Australia by leveraging their Australian operations with a high level of debt. Importantly, the existing thin capitalisation rules do contain an exclusion where entities and certain associates have debt deductions, interest deductions of $2 million or less. The good news is that that's still being retained under the proposed draft changes. So for many of our small business clients, thin capitalisation still shouldn't be a problem. However, and for those clients that are affected by thin capitalisation, these proposed draft changes do fundamentally alter the way you approach calculating whether any debt deductions are denied under these rules. Rather than using an asset-based test, the existing safe harbour test, which most taxpayers currently use, that's being replaced with a default fixed ratio, an earnings-based test. That test broadly caps net debt deductions, net interest deductions, at up to 30% of tax EBITDA. Now, because earnings can be a bit volatile year on year, the proposals do have an inbuilt mechanism that allows debt deductions denied under this particular test to be potentially carried forward for up to 15 years, where they could be used again when the entity does have sufficient earnings. You aren't necessarily restricted to the fixed ratio test, and the draft proposals do contain two alternative approaches that could be potentially available. The first of these alternatives looks at things at the group level rather than the standalone entity level, and basically, in very broad terms, caps net debt deductions, net interest deductions, based on the interest to earnings ratio at the group level using audited consolidated financials. The other alternative approach looks at external party lending and basically caps interest deductions, debt deductions based on amounts lent by external unrelated lenders. I guess what I'm trying to say here is that if you do have clients that are affected by thin capitalisation, they're not exempt, for example, under that 2 million threshold, then these proposals really do fundamentally alter how you approach the calculation. While they're still in draft form, they're not yet law, they haven't been introduced, they are proposed to commence from income years starting from 1 July 2023. So now is the time where it's prudent to sit down with those affected clients to model and forecast whether there's any impact.
Were there any surprises that we weren't expecting when it comes to what's contained in that draft legislation?
Well, yes, this one came as a particular surprise, and it wasn't announced as part of Labor's last budget. And it has the potential to impact Australian resident companies with debt funding used in connection, so to acquire or capitalise their foreign subsidiaries. Now, the starting principle here is that Australian resident companies aren't assessed on dividends received from their foreign subsidiaries where certain conditions, ownership conditions, are met. If the dividends aren't assessable, what that also means is that the Australian resident company can't claim deductions, at least under the general deduction provisions, for expenses used in generating those non-assessable dividends. However, there is a specific deduction provision that does allow Australian resident companies to claim deductions for their interest costs on borrowings where they're used, for example, to acquire or capitalise their foreign subsidiaries, even though those foreign subsidiaries may only pay non-assessable dividends. The draft legislation is proposing to remove that specific deduction provision, so remove the deductions for those interest costs, and it's proposed, at least in its current form, to apply from 1 July 2023. Still in draft form, it's not law, it hasn't been introduced, but one to really look out for if you've got Australian resident companies with debt funding used in connection with their foreign subsidiaries. And if so, potentially there's a complex tracing apportionment exercise to work out what the loan was originally used for.
And that's the roundup for this month. If you're an accountant or an advisor, we'd love to show you what a difference Knowledge Shop membership can make to you. Give the team a call or drop onto the website and book in a time to really see the difference that Knowledge Shop can make every single day to your practice through our technical support services, our CPD, our work paper knowledge base, our updates, our newsletters, and so much more. We'll look forward to talking to you soon.